Don Alexander here with Gene Coda Professional and Executive Search. We recently hosted a webinar that gives you deeper insight into the Life Sciences Pulse Labor Market Report. Although the webinar uses first quarter of 2020 information, the same principles will apply on subsequent reports. If you haven't yet signed up for the report, the link to do so follows in the comments section. Oh, and please subscribe to our YouTube channel while you're here. Thanks, and we hope you enjoy the video. So with that, let's go ahead and get into the heart of things. Bear with me just a moment. So just a word on the Life Sciences Pulse report. So, what is it that we're actually tracking here? What we're tracking is all ads that are posted online. So MZ, their data service, has, let's just call them web bots who crawl the internet. And the technology is able to deduplicate advertisements or posts, and they're able to place them in these various NAICS codes that are specific to industry. What we then do is think about the definition, if you will, of the industry, and we use a bio-industry report. And we place this in the report so you can reference it, but we use a bio-industry report to identify which NAICS codes, in essence, are specific to the industry. And our focus on, this particular report is on the product makers and that are specific to the industry and the support services companies. But BIO's report itself goes a bit broader and really goes into the distribution channels as well. So I wanted to note that we put the specific NAICS codes that we cover in our report right there so that you can see them. So with that, let's move on into what we actually saw in the first quarter of 2020. So this figure 1 is the comparison of all U.S. current life science job postings compared to the prior year. Now this kind of graphic is what's most often viewed in the labor market, and that is the year-over-year comparison in terms of sum totals. So we find that in Q1 of 2020, employers posted 544,000, roughly, ads in the first quarter, and that was up from about 515,000 ads in the fourth quarter of 2019. So we can see kind of, again, that upward progression. And that represented roughly a 5.5% increase on a quarter-over-quarter basis, and then about a 13% year-over-year increase. So going from blue to red here, and so we were pleasantly surprised to see a fairly robust quarter in the first quarter of 2020, and so that was our initial findings there. Moving on to figure 2, this particular slide covers the comparison of quarterly sums, means, and standard deviations of sector ads. And as we kind of get into this, what I wanted to do is take the opportunity to speak. If you're unfamiliar with moving averages and statistics, a moving average is a calculation to analyze data points by creating a series of averages of different subsets of the full data set. And so given a series of numbers and a fixed subset size, the first element of the moving average is obtained by taking the average of the initial fixed subset of the number of series, and then the subset is modified by shifting forward, or that is excluding the first number of the series and including the next value of the subset. The idea behind the moving average, which is denoted by the 2-period moving average of the black line right here, is really to smooth out the short-term fluctuations and highlight trends or cycles that we may see. We actually use a similar model in our forecasting of the following quarter. And 2 points that I'd like to touch on with respect to this particular figure 2. And one of those is that in Q1 of 2020, what we saw is that there has been a moving average decline for 2 consecutive quarters in a row. And what that would suggest then to us is that ads would in fact follow that same pattern downward in Q2 of 2020. We also note that the standard deviation, whenever generally, because this is measuring inter-quarter, the standard deviation of the months within that quarter, whenever things move on a rapid format, whether it's up or whether it's down, we tend to see more standard deviation, which suggests again some level of volatility one way or another. So then what we'll do is review some of the subsector components that make up the life sciences sector in the report. And so figure 3 is the 3-year quarterly industry posts by subcategory. And we'll go into a little more detail with each of these, but the RTM, Research Testing Medical Laboratories, is denoted by the red bar graph. PMM, Pharmaceutical Manufacturing, Medicine Manufacturing, is the blue graph, and then MD, or Medical Device and Equipment, is the green segment. Now, one thing that we like to try to touch on or review when we're looking at this particular graph is, in this figure, is the relationships between the different subsector components. So if you notice that here in Q2 of 2017, we see that the RTM and PMM components advertised roughly the same figures. And as we moved along throughout some time, a couple of quarters later, in particular Q4 of 2017, we see those patterns start to diverge, and we see them really diverge from that point heading forward into the present day. And so what that tells us, or what we believe that tells us, is that the trend might be best characterized as the overall industry trend towards outsourcing. And that's because the RTM segment of the market contains many of the names that you would think to outsource to if you're in the industry. So figure 4 is our first subsector. It's the 3-year research testing medical lab ads broken down by quarter. And again, at this point, we'll start to look at these different subsectors. We note that in this particular quarter, that RTM increased roughly 18% on a year-over-year basis. So did increase also clearly from Q9 to Q4 2019 to Q1 2020, but also increased on a fairly significantly on a year-over-year basis. Once we get into the pharmaceutical and medicine manufacturing ads by quarter subsector here, as denoted on figure 5, what we are doing here is we're introducing the concept of equity correlations. Now, the stock market is known as what's called a leading indicator. Employment has historically been thought of as a lagging indicator, but there's evidence to show that employment is in fact maybe a leading indicator, or perhaps what's known as a coincident indicator. Leading indicators provide more foresight as to where things may be heading, while lagging indicators, as their name implies, act as more of a confirmatory after the fact observations. So since ads themselves generally precede hires, or employment is one way to think about that, ads posted should give us a leading indicator or a leading signal, if you will. Now, what we do specifically is we normalize, what I call normalize, equity and ad posts at the beginning of each quarterly report, because what we really want to do is look at where divergences between equity prices, as denoted rather in the blue line, where those kind of trend versus the trends in the actual ads posted during that quarter. So we'll see in some cases pretty significant differentials in the relative correlations of prices to stock market prices to ads actually posted. And really what we're doing in this case is reviewing more of the trend lines, if you will. And so when we compare the ads posted, say over the past quarter, versus relative equity prices, we do notice again that Q1 of 2020 would suggest to us that downward momentum, if you will, heading into the second quarter of this year, which we're already in. So we'll now look at the, we'll look at the medical device and equipment ads by quarter, which is figure 6. And we note that on a year-over-year basis, the MDE segment of the market increased roughly 6%. So again, with MDE, we do notice that there is downward momentum heading into the second quarter of this year. But one thing, again, to touch on, and this doesn't always happen, all 3 of the subsector components showed positive year-over-year growth. So if we think about RTM, PMM, and MDE, that again doesn't always happen in lockstep. So now what we'll do is get into kind of, I guess, what I'm going to call the high-level summary, if you will, on what we might expect going forward. And, I think this is certainly talked about on the news on how difficult forecasting is in a variety of circumstances given COVID-19. So we just make that blanket statement that it's kind of hard to forecast at this point, even more so than usually. But we do put a forecast of about 520,000 total postings for the sector heading into Q2, which if that number's accurate, that would represent about a 6% decrease from the second quarter of last year, so the same time frame. We do see that really more in a single digits capacity within the range because, as the statement here says, the U.S. government investment, of course, there's other governments as well, investing in various diagnostic tests, medical equipment, repurpose new drugs, vaccines. And so just given the inherent nature of the industry that we find ourselves in, we don't see as significant a downside as perhaps with other sectors of the economy that are in fact being hit, reasonably hard at this juncture. In addition, we also expect the average ad age duration, which is presently at about 48 days, to continue to increase in the first half of 2020 as roles take longer to fill. Now, the theme behind this is that this is partly due to the logistics associated with interviewing, but it also contemplates a more tepid response for those presently employed to actually change employers during the pandemic. So, our advice, even under, this set of circumstances, is for companies to plan. In essence, they should plan several weeks out, if not months, in advance to recruit highly specialized skill sets in the industry. So if you need to hire in September, my advice is to start getting going in June.